Accounting Standard 1, or AS1, exists to enforce a single concept: the mandatory disclosure of a company's accounting policies. The intent is total financial transparency. Yet written into its core principles are structural vulnerabilities. Look at this rotating object. Two different companies can experience the exact same economic reality, process the exact same cash flows, and report wildly different financial health while remaining strictly legally compliant. This chart maps how that divergence occurs. Identical raw financial data flows in, but before it reaches the public ledger, it passes through a black box of AS1 discretion. The output is two different profit and loss profiles. One shows strong margins, the other shows a struggle to survive. This happens because AS1 is a principles-based framework. It relies heavily on management judgment. In a rigorous system, flexibility is a feature. In financial reporting, flexibility is an attack surface. Subjective terminology embedded in the standard gives management the legal cover to create hidden reserves or omit sensitive disclosures. By choosing the right interpretation, they dictate the narrative. We're going to map these specific points of failure. By stripping away the subjectivity and deploying rules-based deterministic legal amendments, we can patch the AS1 protocol from the ground up. If a financial standard allows for vast subjective interpretation, it ceases to be a standard. It becomes a legally sanctioned loophole. Rebuilding the protocol requires establishing strict rules at the point of entry, the input layer. This is where raw data is categorized before it touches the ledger. The first vulnerability at this layer is the concept of prudence. Prudence is meant to prevent overstating profits. In practice, management weaponizes it to intentionally over-provision, stashing away hidden reserves to smooth out future earnings. This diagram shows the required legal patch. We strike out management judgment and prudence, replacing them with hard requirements, verifiable evidence, and measurable estimates. Excessive or arbitrary provisions are explicitly prohibited. Any provisioning must now survive mandatory audit adjustments based strictly on the math. The next subjective trap is materiality. Unscrupulous entities classify millions of dollars in liabilities as immaterial, simply to avoid disclosing them to shareholders. We close this by stripping the word immaterial from the rulebook entirely. It is replaced by quantitatively defined materiality thresholds. Under this update, any omission or misstatement that crosses these specific numerical bounds triggers an automatic, mandatory disclosure. Judgment is removed from the equation. Then there is the ambiguity around substance over form. Companies frequently structure transactions legally to obfuscate their true economic impact, hiding debt or inflating asset values. The fix here requires shifting the absolute priority. All transactions must be recorded based on their underlying economic substance, regardless of the legal paperwork framing them. Any attempt to record a transaction based purely on its legal form now requires detailed justification and a specific independent audit certification. By replacing subjective terminology with deterministic thresholds, the input layer actively filters out management bias before the data ever reaches the financial statements. Perfect inputs mean nothing if the final formatting breaks inter-entity comparability. We have to secure the output layer. This side-by-side grid illustrates the current state of comparability. Because AS1 permits disparate accounting policies, Company A and Company B report the same industry realities using entirely different metrics. Entities also selectively highlight favorable policies while burying the rest. The solution is strict legal standardization across critical reporting areas. Depreciation, inventory valuation, and revenue recognition must adhere to prescribed uniform policies. The metrics align, and direct peer-to-peer comparison becomes possible. But companies also avoid comparison with their own past. A sudden midstream change in an accounting policy can obscure massive financial deterioration. To prevent this, any policy change must carry a mandatory disclosure detailing the nature of the change, the reason, and the exact quantified impact on profit, assets, and liabilities. Even with these rules, assessing a single-year snapshot allows entities to hide long-term trend manipulation. We enforce historical transparency by extending the requirement backward. Financial statements must now include a comparative policy impact statement, covering at least 3 preceding periods. Failure to map the comparative effect across those exact prior periods renders the entire financial statement non-compliant. Standardization forces disparate, chaotic data into a rigid, load-bearing structure. By mandating a rigid, multi-year reporting matrix, a company cannot hide isolated poor performance behind a sudden, localized shift in its accounting policies. We now have perfect input rules and output formats. But without severe penalties, compliance is an illusion. We need systemic enforcement. Look at this three-tiered architecture. Disclosing a policy on paper means very little if it is ignored during actual daily implementation. These red nodes represent deviations slipping past manual oversight. The patch mandates the installation of automated compliance systems directly integrated into an enterprise's ERP software. When policies are not consistently applied, the system detects the anomaly in real time. Deviations trigger immediate audit alerts and halt the data flow. Currently, AS1 has no credible penalty mechanism. When the cost of non-compliance is negligible, violation becomes a standard business practice. The new legal threshold removes the benefit of the doubt. Any omission of a significant policy is no longer classified as an error. It is legally treated as deliberate concealment. Enforcement requires leverage. Non-compliance now triggers the mandatory restatement of financial statements and invites immediate regulatory action under applicable corporate laws. By hardwiring compliance into internal software and criminalizing omissions, the standard transitions from a reactive auditing checklist into a proactive enforcement machine. We have overhauled the framework. What was once a subjective honor code is now a highly secure, deterministic mechanism. Returning to our original data flowchart, the vulnerability of the old black box is gone. It is replaced by a transparent, rigid filter grid. Raw data processes through quantitative input thresholds, is constrained by comparative formatting, and is monitored by automated penalty systems. These components are not optional enhancements. They are the absolute minimum requirements to guarantee that financial statements reflect a genuinely true and fair view. The loopholes created by discretion, selective disclosure, and weak penalties are closed. Advanced accounting standards exist to reveal undeniable economic reality. They do not exist to provide the flexible tools to creatively obscure it.